Hi, welcome. It's Mary Ellen McGonigal here with your Weekly Edge show for Saturday, April 9th. Let's get started. Take a look at what we are going to be reviewing today. First up, some of the more impactful news that had the markets really quite volatile again this week, certainly to the downside more than not. And also from there, we're going to take a look at how we closed the week. Are the markets still finding support, or is there potentially further downside ahead? Viewer question of the week. And this week, it's all about some key metrics that you can keep an eye on to really help keep you in tune with the broader markets. So let's go ahead and get started. First up with the economic news, and the Federal Reserve did release the minutes from their most recent meeting, and it was there that it was confirmed that they are going to have a more aggressive stance as it relates to fighting inflation with their raising of interest rates. It's anticipated now that it'll be about 0.5 point each meeting, but even more importantly is that they are going to begin what's called reducing their balance sheet as soon as their next meeting in May. And this was very impactful news. Quite simply, it means that the Federal Reserve will be liquidating their inventory of these bonds. In turn, the net result was a spike in interest rates, and that in turn pushed growth stocks lower. We'll get into all of this as we move forward. As mentioned, bond yields did rise to their highest level in 3 years. Very impactful. Also, there were further sanctions against Russia, and that in turn drove select commodities. We'll look there. Also, COVID cases in China are continuing to hit record highs. That in turn is lowering the outlook for consumption of many products. And also, we did see defensive sectors of the markets post the biggest gains for the week. So let's take a look. Where did the markets close for the week? Here we're looking at a daily price chart of the S&P 500. The S&P was down about 1% for the week, and we're going to key in on where it did close the day. And in this case, we're looking at this blue 200-day simple moving average. We want to make sure that it is continuing to find support there. And the 200-day is currently at 4492. From here, what we can do is take a look and see that the index closed at 4496, so just above that 200-day simple moving average. So certainly constructive. Also, we do have this relative strength indicator, RSI, in positive territory, while the faster moving stochastics have moved into a negative area. So overall, cautiously constructive on the S&P 500. From here, let's take a look at the Nasdaq. This index was the hardest hit. It was down 3.6% for the week. And again, keying in on these shorter term moving averages, we can see that the Nasdaq closed below this red 50-day simple moving average. The concern is there's no other moving averages that can act as support. Your next downside area of potential support is this low in January, which is almost 6% away. The RSI, your relative strength indicator, is in negative territory, as are the stochastics. So the near-term outlook for this tech-heavy Nasdaq is negative. So from here, what I'd like to do is go ahead and dive in, take a look at some of these sectors within the S&P 500. We want to see where relative outperformance is taking place. It was not all negative in the markets. And here we are with those 11 sectors, and it's a 2-month daily price chart view. I've gone ahead and added this relative strength indicator, sorted it in descending order so that your relatively stronger areas are up here in the forefront, and we can see utilities, staples, healthcare, and real estate. Each of these areas are defensive in the sense that they fare well despite any economic rockiness, but more importantly, they offer a high yield, many of the names underlying. and are great hedges against rising interest rates and inflation. Also, energy was among the top performers this week with a 3.2% rally. Today's 3% gain on Friday was all about analyst estimates revised upward, which helped boost select stocks in that group. From here, we want to take a look at these underperformers. Make sure you're not overweighted if you are a near-term or shorter-term investor. And we can see technology in line with that Nasdaq really fell out of bed. It was the worst performer, 3.8% down on the week outside momentum indicators. Certainly your RSI is negative and your MACD had that negative black line through the red crossover. More importantly, this sector is below each of its moving averages, so not constructive there. Also, you want to be aware of this decline here in industrial stocks, XLI, all about transports and the outlook for some of these truckers, rail, and shipping stocks pushing this group lower. From here, let's go ahead and take a look at other industry groups that are very impactful as it relates to being helpful in formulating an opinion as it relates to the markets as well as individual stocks. So again, a 2-month daily price chart view. I have the yields here, other very impactful groups listed. And again, that RSI in descending order. And let's take a look. This is that spike in treasury yields that I talked about. This is the 10-year bond yield. And it really did go up quite a bit this week. It's at a 3-year high. And in turn, I mentioned the negative impact that that has on growth stocks. For those of you not already, I urge you to take a trial of my MEM Edge report for those not already subscribers. And I will discuss this in great detail as well as what to be on the lookout for those higher growth names. Up here in the forefront as well is the U.S. medical devices. I talked about healthcare being a top performer. Certainly this was one factor, although more impactful was a rally into large cap pharmaceutical stocks such as those on our MEM Edge report. So from here, I talked about some commodity related stocks that were impacted. This is GLD. It was up in and otherwise down market. We can see potentially reversing this recent period of consolidation, another hedge certainly against inflation as well as uncertain times. Down here in this lower performing area, we can see semiconductors down almost 8%. And this was a big impact on not only the Nasdaq, but also that technology sector. Definitely in a declining phase and worth noting if you have holdings in that area. It is in a downtrend. We can also take a look at bank stocks. While they normally would fare well in a rising interest rate environment, there is what's called an inverted yield curve where shorter term rates are higher than longer term, and that is not good for banks. Another area that I wanted to share with you very quickly here is that Volatility Index, better known as that fear index. We closed at 21. Anything above that 18 level indicates heightened uncertainty among investors, so still not out of the woods relating to the volatility that's out in the markets as well. So from here, I'm going to go ahead and review that viewer question for the week, and it was all about how one can very quickly stay on top of the broader markets and where this strength is. And I did in the beginning here share with you that candle glance view of the sector. That's one great way to do that. Another way that you can do it is to stay on top of the mega cap, what are called FANG stocks, Facebook, Amazon, and so forth. These heavyweights really move the markets, and in particular the Nasdaq, but both indices really are very heavily impacted. So what I'm sharing with you is, again, this 2-month daily price chart of those heavyweight names, Tesla, Facebook, and so on. And in essence, it's critical that these stocks remain in an uptrend to help buoy the broader market indices. We can see, unfortunately, that these stocks did not hold in that well last week. In particular, Netflix, they're due to report earnings in a couple of weeks, and they had this brief reprieve following the Oscars award, but subsequently has deteriorated. And then we can also take a look at Google, which this week broke below each of its moving averages and is trending lower. Another name that is very close to potentially breaking support is Amazon, that 50-day moving average at 3092. The stock closed at 3089, so we're dipping just below that potential area of support. On the plus side, Tesla has been able to hold in, certainly good news relating to their vehicle delivery statistics and data, but unfortunately it too did pull back with these growth names that are getting hit. We're going to be on the lookout for this black line down through the red, indicating a potential shift of that uptrend similar to this mid-November period. If that is coupled with a negative RSI, that would not be good news for Tesla. So another way that you can very quickly and easily stay on top of what is or is not working or the broader markets is to take a look, in this case, the Dow Jones index component. And the reason I'm pointing that out is the Dow was flat for the week while the S&P was down 1%, the Nasdaq down 3.6%, small caps were down 4.6%. So the Dow is no longer an industrial index. It is much more of a broad-based index as it relates to the economy. So let's take a quick look at the Dow and uncover why that was able to end the week unscathed. So here we are again with that candle glance view, your stronger areas up here in the forefront, and sure enough, we have Merck, Amgen, two heavyweight healthcare names, both offering very generous yields and also having strong growth prospects. Walmart is up here in the forefront. It may be surprising, but they've had several positive announcements. We can see this very nice, significant uptrend taking place. In addition, a peer company that's also a big box retailer came out with strong numbers on Friday that helped boost this stock. And then as we move forward, we can see additional healthcare related names, Johnson & Johnson, United Health. They're due to report next week, and they had a very nice week. And then also consumer staples. I did mention that as being in the forefront. Coca-Cola among the top performers for the week. And companies such as Coca-Cola, and we have Procter and Gamble down here as well, are really on the move. They have been able to raise and pass their higher prices on to consumers, and in turn been able to keep their growth prospects in good standing. McDonald's, another discount, certainly restaurant name that offers a nice high yield, and Travelers was among insurance companies that rallied this week. So these are the areas that are helping certainly with the Dow to buoy and support, and it's also an area that you can focus on if you are interested in hedging against this high inflationary period. As we move down, these are the weaker areas that of course are in areas that you're not going to want to overweight. This is CRM, a heavyweight software company, and software stocks were hit with these growth stocks this week. And then other areas are financials, JP Morgan, and we talked about that move away from these larger bank stocks. Goldman down here, both are due to report earnings next week, so we will be keeping an eye on that. That's it for this week. Everyone have a great weekend. I look forward to seeing you next week. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.